Hello, everybody, and welcome to the Game Changers audio experience with myself, Adam Strong. And today we have another fun-packed show. I'm super excited. We're going to be joined very, very shortly with a good friend, David Horne. David is, I've known David for about 18 to 24 months, and we share very similar personal values. I love it. I love the fact that David really goes out of his way to help and serve society and people, not just here in the UK, but from people from all over the world. Now, David is also a best-selling author. He has a book called, I think it's Add Then Multiply. Add Then Multiply. He's the founder of that company. He used to be a former CFO for two previous companies, and he's raised a humongous amount of money. I believe he's going to recorrect me here, probably around £100 million in funding over the last, I don't know, in his entire career, which is absolutely insane. What else can I say to you? And we've collaborated on a couple of occasions, and he's really gone out of his way and really helped not just you guys that are listening in today, but also if you have any questions around what we're going to be talking about today, which is all about fair funding. So what is today's agenda? What are we going to be talking about today, guys? Well, we're going to be talking about, number one, we're going to be talking about the different avenues when it comes to if you want to grow and scale your business, what are the different avenues that you could actually go down? So we're going to explore that. Secondly, we're going to be talking a little bit about diversity. What do I mean by diversity? We're going to be talking a little bit about why female entrepreneurs and business owners are not being recognized and not being seen as to get more funding, because David's going to give us some really shocking stats and statistics, and is a real big what we call female power, women entrepreneur type of empowerment person in the funding space, which I love. And he's got a project, a social enterprise, which he heads up as well, which is amazing. So if you have any questions around funding, do me a favor. Use the comments in the comment section. You can do that in the comment section below. So without further ado, my good friend, Mr. David Horne.
Morning, Adam. How are you?
I'm good. How are you today?
Excellent. I'm very well, thanks. Very well. Excited to be here.
Excited for you to be on the show as well. Am I coming in clear, by the way?
You're coming in clear. Every now and then your picture freezes, but you're coming in clear.
All good. Well, great to have you on the show. And what was I going to say? I know that we're going to be talking about a wide diversity of different topics.
Yeah.
I know that you're Canadian originally, right? So just give a little bit of a background for people that don't know you. I know we've got listeners from all over the world, but you're Canadian and you end up in the UK. Just give us a quick, brief background, if you could, and how you got into the whole kind of funding space.
Absolutely. So, hi, everybody. David Horne. I was born and raised in Vancouver, qualified as a chartered accountant with PwC a long time ago in 1987. I am a fluent German speaker, and I told PwC when I qualified that I wanted to work in a German-speaking office. And one day I came into the office, and this is showing my age now, but there was a telex. For those of you youngsters who don't know what a telex is, Google it. You'll be surprised. There was a telex from Pricewaterhouse in Zurich offering me a job. And so in the summer of 1987, my wife and I packed up. We sold off our few belongings. We'd been married 4 years, so didn't have much. Packed our clothes into 4 suitcases, got on board an airplane with one-way tickets and a 2-year employment contract. And that was 34 years ago. And ended up staying in Switzerland for 6 years, 2 years with PwC. And then I joined a client. Worked with them. It was a big blue chip corporate. Worked with them, transferred with them to London in 1993, and have been in London ever since. And stayed in big blue chip corporate world with companies like NCR, AT&T, and the BBC. And then starting in 2000, I started working with very entrepreneurial businesses, larger entrepreneurial businesses, but still run and led by founders. And the first one was a PR agency group. The second one was a digital media and publishing group that was listed on AIM, which is the junior market on the London Stock Exchange. And the third one was an online auction business also listed on AIM. And those 3 businesses had one thing in common, which was that they raised capital and bought other companies. And so I became an expert in fundraising and M&A, always on the side of the entrepreneurs. I've never worked in an investment bank. I've never been a venture capitalist. I've always worked directly with entrepreneurs. And I left that world in 2010. Started working with founders of SMEs, getting down into the very much the smaller end of the scale. Had some interesting things, got involved in a number of startups myself as a founder or co-founder. And then in 2015, I went on an amazing development program that I know Adam's been on as well. And that really helped me to cement my thinking and realize kind of the mountain of value that I bring to the world that I wasn't really, I hadn't really thought about it in that context. And that is that so many founders of SME businesses don't really understand the world of fundraising, don't really, they think about fundraising and M&A being the stuff that the big boys do. And that's not the case. And in fact, I've written a book about it called Add Then Multiply, like my company.
Oh, there we go. Hang on a minute. Oh, there we go. There we go. Make sure you get that, guys. Okay. There we go. Dun. Make sure you check that out on Amazon, by the way.
Yep. Thank you. And basically, since that book came out, I've worked exclusively and do now with founders of businesses who are looking to scale through raising funds and acquiring other companies, or potentially selling their own business themselves and going on and doing other things.
Interesting. It's interesting, isn't it? Because I know you were talking about M&A.
Yeah.
But now in the digital arena, especially over the last 18 months, I don't know about you, but my general observation about the M&A industry right now is that it's extremely a great opportunity to be in. There's lots of great opportunities to be in.
Absolutely.
And I'm like, I've got so many friends that have gone into this industry over the last 12 months, and they're flipping. Their idea of flipping businesses like property or real estate is insane. And I'm like, yeah. I'm so excited. It's kind of crazy.
No, it is. It really is. And, there's all sorts of different routes that you can do. I tend to focus more on not so much the short-term flip, but kind of the longer term. I'm a big Warren Buffett fan, so I like to look at, building long-term capital value. But yeah, there are some amazing opportunities out there. And people don't even think about it. You can acquire a competitor to scale yourself in your industry. You can acquire an upstream supplier to control the supply chain. You can acquire a downstream customer, or you could even acquire a business in a related vertical industry that, where maybe they've got customers that want to use what you've got, and you've got customers that want to use what they've got. So you can really increase the scale of both companies through a transaction like that. So yeah, it's a more advanced strategy. I typically am working with companies that are turning over at least £1 million, because less than that, if you're doing any kind of fundraising, the investors will end up taking control of the business, and that's not really right. And I think it's better to demonstrate that you can scale your business to £1 million and then beyond. But then it's a really great way to turbocharge. And in fact, one of the case studies that I write in the book, I joined, this was the digital media business, which was AIM listed. I joined the founder of that. They were turning over 1.1 million. 3 years later, they were turning over 27.7. So we tripled the business every year for 3 years.
I hope they give you some good bonuses, by the way, off the back of that. apart from that dreaded salary, God damn it. Anyway, it's kind of funny. Anyway, it's all good. In fact, it's interesting because we were. I was going to say about the emotional attachment. That's probably is that the reason why you focus on over 1 million?
I mean, the emotional attachment. No, I think the reason why I focus on over 1 million is really twofold. Number one, when you've breached £1 million in sales, you've got something that it really has an opportunity in the marketplace. You can go out and launch a business and turn over 100 grand, 200 grand, and if it's just you, it's a nice little lifestyle business, and there's absolutely nothing wrong with that. But it's not yet a scalable type of thing. To have reached £1 million, you're typically looking at having a team of anywhere from 6 to 10 people. And you've all of a sudden got people handling sales, you got people handling operations. It's not just you as the founder. You've got a structure that now has the ability to scale. And as I said before, also, once you've reached that level, you've got a certain value in the company. So, if you wanted to go out and raise, say, £1 million to do another big deal, well, yeah. If you're only turning over $500,000, it'd be very difficult to justify any significant valuation, and so your investor would end up owning the vast majority of the business. And that may be the case one day, but you don't want that for your first transaction.
True. Good points. It's interesting because when I suppose even to this day, not me personally, but not now anyway, but I used to have real gaps in my knowledge when it comes to fundraising, right? Whether it be, what is that? So I know that some of our listeners that are listening in, they're all at different points, right?
Yeah.
Some of them might have established businesses, maybe already at the 7-figure stage. Some of them are already in the 6-figure stage. Some of them are already in the 8-figure stage, but I suppose we're all on different journeys. So I guess my question is, could you just give us a quick overview about some of the different routes of fundraising and what are maybe some of the pros and cons of each one?
Yeah, sure. So, I mean, the most common thing is most businesses, and this is how most businesses start out. It's bootstrapping, and that's where you as the founder put in your own money, and then whatever sales you can generate is what you can invest into the company. And there are many companies that grow very successfully 100% bootstrapped and very well done to them. But if they're looking to, the whole point about raising funding is to accelerate your ability to grow. Because, if you think about it, if you're bootstrapping, you might be able to grow your business at 10 or 15 or 20% a year on year. And doing that, you're doing well. Unless you're in an incredibly hot sector, you're not going to be looking at how do I triple my business every year for 3 years. You need to have the ability to raise funding and grow through acquisition there. So the different kinds of funding, I'll talk about angels, I'll talk about crowdfunding, and I'll talk about institutional, and I'll lump a bunch of things into institutional. So angel investors is traditionally where a lot of early stage businesses go. And angel investors tend to be wealthy people, often people who've had their own business and it's been successful and they've sold it or generated a lot of cash from it. Kind of like the Dragon's Den, but the world of angel investing is not like Dragon's Den. Dragon's Den is a reality TV show. But
just dressed up.
Have a concept. It's something like that. And so these are wealthy individuals who've built businesses themselves, and have typically sold out and are looking to do something to help people. But they're also looking to do something to grow their money. So then, it's not charity, it's not philanthropy, it's business. But they are experienced business people who are looking to help businesses that, either they, fit their sector, they can open up their little black book, introduce contacts, things like that. And kind of an early stage. The other thing that's early stage that is really, really growing in popularity over the last kind of 10 years is crowdfunding. It's very well established in the UK. It's very well established in North America. It's getting more established in Australia. Other countries around the world, I'm not sure where it is on that development curve, but it's definitely coming forward. And part of the challenge with that has been from a regulatory perspective, because hi Sarah, because the whole financial fundraising system has historically been designed to protect consumers from less scrupulous people who are going out and trying to take their money. And so the system was very rigidly structured, and rightly so. But it came to the point where, I could be down at the pub having a beer with my mates, telling them about my new business venture, and one of them might say, "Oh, I'll put 20 grand into that." And technically, I would be breaking the law if I received that money from that person.
Really?
Because, yes. Yes, technically.
Wow. Wow.
Because either they weren't or you weren't going through the process of being a authorized person under the Financial Conduct Authority in the UK.
I
Now,
see. I see.
it still happened. It still continues to happen, but technically you're breaking the law. What the crowdfunding companies have done is they have created a platform, and they have worked very hard with the regulators to enable regular, ordinary people to come in and put money into SME businesses. And they've actually established a new threshold. So the criteria, and this is a very UK focused thing. So apologies to the international community, but there will be similar. I know there are similar things in North America. I know there are similar things in Australia, where there are different levels of investor. And so there's a thing called a high net worth investor. And you're allowed to raise money from high net worth investors. And that's someone who earns more than 100 grand or has more than 250,000 in assets outside their home and pension. Or a sophisticated investor. And a sophisticated investor is someone who is part of an angel syndicate or works in the investment industry. Or, and this is an interesting one, in the UK, if you're a director of a company that turns over at least £1 million, then you are considered to be a sophisticated investor. But if you're not, then you can't make these investments. And so what the crowdfunding community has done is created another layer, which is called an everyday investor. And these people are allowed to put money into these companies, but there are certain limits. I think they're not allowed to put in more than 10% of their income. And it's all a self-certification process, but it's just designed to protect them, but equally to enable them to participate in small companies. And so the main equity crowdfunding sites in the UK are Crowdcube and Seedrs. For your listeners around the world, just go onto Google and type in equity crowdfunding near me, and you'll get whatever the ones are in your country. But crowdfunding is a really cool concept because it enables you to raise money from a wide community of people.
Yeah, and I think what I love about crowdfunding is that it can really spread your message, much further than you want it to be. Do you know what I mean? Like conventional ways of, going out to the media and doing a press release and stuff. You can do those things, but really with crowdfunding, when someone makes a donation, normally it like spreads within their network, like a bit like a virus. You know what I mean? Everyone knows about it, type of thing.
Yeah. Now you just mentioned a very good thing there, Adam. So you said when someone gives a donation, there is donation-based crowdfunding where basically I'm going out seeking money and people give money. There might be a reward or something. But the other one that I was talking about, which is Crowdcube and Seedrs, is equity crowdfunding, where you're actually selling stakes in your company.
Selling stakes, yeah.
And so people are investors. People will become shareholders in your business.
Interesting, very interesting. So those are
the two entry level ones, and then institutional investors. This is where firms are bringing in money from other institutions and professionally managing it. So this is venture capital, family offices, private equity, all of those types of things. And so there will be professional managers collating that money and then investing it on behalf of their investors. And venture capital is probably the one that most people will have heard of or be aware of if they're interested in this space. And so venture capitalists, I mean, it's interesting. The venture capital model has evolved and developed over years, but right now it's a fascinating arena, but they are absolutely focused on where's the next unicorn. A unicorn is a company that can have a valuation of $1 billion. Now, there are only 862 unicorns in the world today. So they're fairly rare beasts. But these guys are totally focused on finding the next one. Because if you think about it, let's say I raise a fund of 100 million. And I'm going to invest $1 million into 100 different companies, and it's kind of spray and pray. It's an educated spray and pray, but it is kind of a spray and pray, because out of those 100 companies, I know that 10 or 15 of them are going to go bust, 80 of them are going to go nowhere, some of them will take off, and if I get lucky, I might have invested in a Google or a Facebook or a Tesla, and that one is going to absolutely shoot the moon, and it's going to pay back the fund, and it's going to provide a return for everyone, and it's going to pay all of the costs of the running the venture capital business. So that's the model. It works, and as long as you find that big one, it's a very, very lucrative model. Where it falls over is if your business doesn't have the potential, or isn't looking like, or you as the founder aren't saying this is going to become a unicorn, these guys aren't interested.
No.
And that's where the whole funding focus side of things comes in, because there are a huge number of really good quality businesses. Many of them are run by women or underrepresented entrepreneurs of every gender, so racial minorities, different sexual orientation, whatever. Literally, and again, this is the thing. It's almost like there are two playing fields. One is if you're a white man like Adam and I are. One if you're everybody else.
Yeah, we'll talk about that actually, because that's interesting. And I know we had some very interesting discussions the other day in our Game Changers Inner Circle group, and I never even knew what that was, but we'll share that with the listeners if that's okay. We just had a question.
Neither did I, Adam, 2 years ago, or about 3 years ago, before I discovered it.
That's insane. So Daniel Tahini, who's on LinkedIn, said, good to hear from you both. Why fundraising and not IPO?
Great question.
On that? That's a great question, isn't it?
Sure. So IPO is initial public offering, which is when you list a company on the stock exchange. And the main reason, I mean, IPO is also a form of fundraising. I didn't mention it because for many companies, for many people, they're not sure, that's kind of the ultimate step, listing your company on the stock exchange. So I guess the main reason I didn't talk about it was because for many people, it's out there. I do talk about IPO in my book as one of the options. And it's absolutely a route that you can go down. It's expensive. The cost of an IPO on the main market of the London Stock Exchange is now, including all the fees you pay to bankers, to lawyers, to reporting accountants, your non-exec directors, all of those things, you're looking at probably £400,000 or £500,000.
Wow.
To properly launch a business. So it's a big deal. But look, if you've got a business that's turning over 25, 30, 40 million, and you can scale it significantly, then an IPO is absolutely a fantastic route to go down.
Is with regards to IPO, how do you know from your perspective when is the right time to go to IPO? Is it a certain amount of turnover? Is it the growth year on year? Obviously you've got to have sustainable results over a set period of time and a track record. You wouldn't just launch a business and then 2 years later you think, oh my God, I got to go IPO. No, you're not.
It's all of the above. It's there's a whole set of criteria. Typically, if you're looking at launching an IPO, you want to be able to justify a market value of your business of at least 50 million. Simply because of because it's cheaper to seek private funding than public funding at that below that level. One of the great things about IPO, and as I said, I was the CFO of two companies listed on AIM for 8 years, and for 8 years in total. So I understand completely life in the public markets. And the great thing about being listed is you have access to phenomenally deep pockets of capital. As you said at the very beginning, Adam, I've raised over £100 million in my career. Most of that was through the stock exchange. I'd say about 10 to 15% was privately, and the rest of it was through the stock exchange.
Yeah, very cool. Love it. Very good. So Daniel, I hope that answered your question, by the way. Great question, and it's a good one. We like that. Very cool. Now, I know that you've also got another, what I call separate business, which is a social enterprise, which is all about helping female entrepreneurs specifically, or business owners, in helping them to be more recognized, I think the word is. And because tell us about this shocking statistic about raising capital and investment, because our listeners are going to be really shocked about this. When I heard about this 2 days ago, I'm like, oh. But tell us more about that, and how did you? What was the reason why you decided to kind of move into that arena?
So I was speaking at an event a couple of years ago. It was an SME event, and I was talking about fundraising. And after my talk, a woman came up and asked why so little funding went to female entrepreneurs. And I had no idea that this was an issue, but I said, I don't know, but I'll find out. And as it happens, I had a meeting in the diary the following week with the chief executive of the British Business Bank. She and I had met at a networking function, and this was just a follow-up. A follow-up back in the days when you used to meet people at events and then meet them in their offices. And so we met and had a lovely conversation. And towards the end, I thought I'll just ask her, does she know anything about this story? And she smiled and reached down to the bottom drawer of her desk and pulled out a bound research report called UK VC and Female Founders. And it's a report that was commissioned by the British government and carried out during the latter stages of 2018. They looked at every venture capital deal in the UK in 2017. And they found that all female teams submitted 5% of the pitch decks and got less than 1% of the money.
Wow.
Mixed gender teams submitted 10% of the pitch decks and submitted 20% of the pitch decks and got 10% of the money. And all male teams submitted 75% of the decks and got 89% of the money. So there's already this huge skew. And I was blown away when I read into the detail behind this. And then I started researching, and very similar statistics coming out of North America. In the United States, all female teams were getting less than 2% of funding. There was a report that came out last year, in the third quarter of last year, when the venture capital industry grew, the share of funding that went to female teams declined by 30%. And just, it's the same thing around the world. And so I then put on an event at the London Stock Exchange in November of 2019. And that's where I discovered that not only was this an issue that impacts women, but it also impacts underrepresented people. So whether that's racial minorities or whatever. I've spoken with founders who are Black or Asian, and they face exactly the same challenges. And it's partly a case of unconscious bias, and it's partly a case of most of the venture capital industry is white men, and guess where they went to university? Oxford, Cambridge, London School of Economics. Or if you're in the US, where did they go to university? Harvard. Stanford, MIT, Yale. And it's this, we have this little camp community, and hey, you look like me and you went to the same school, so I'm going to invest in you.
That's crazy. Honestly.
I'm just going to jump in with one. There was a study produced by Boston Consulting Group, so a big global reputable firm, and they looked at a whole bunch of deals in the United States, and they found out that female-led teams generated 2.5 times as much revenue per dollar invested as male-led teams. 2.5 times as much. That's not a little discrepancy. That's big.
It's interesting as well, because I think, now here's an interesting statistic, and I know about this because I worked in this space myself. The other stats and statistics is that if you have female leaders within your senior management team, and that generally is within the Fortune 500 companies, those companies will absolutely smash all the previous 501 compared to 500. They will smash it. The reason being is because they have the female people on the senior management team, and so they've got those stats and statistics, but yet there's this kind of gap between funding, and which I find completely bewildered more than anything else. I mean, what do you think?
It's bonkers. It really is. It's bonkers. And you know, again, part of the problem is the fact that the venture I'm not saying that the venture capital model is broken. It's not broken. It works perfectly fine if you fit it. But if you don't fit it, it's a huge uphill battle.
Yeah, I agree. All right, well, we're going to come back to that.
I'm working with a number of partners around the world on different ideas and things that we can do about this. So yeah, watch this space.
Watch this space and see what happens. Well, definitely, we're going to come back to that. Daniel says, thanks so much for the elaborated response.
Pleasure, Daniel.
Very cool. And yes, they are indeed shocking stats in this day and age. 100%, I agree with you, Sarah. Definitely. Very good. All right. So what I was going to say to you, I wanted to ask you a particular question, which was all about, I know that you've been in the world of working in the world of finance and working with businesses for quite a number of years.
Yep.
And I want to talk to you a little bit about some of the common mistakes that these guys make, because I know I feel like an educated man, but I honestly knew nothing about, you know, the whole kind of thing. I used to think to myself, oh, I want to hold 100% of it's my business. It's like kind of Pinky in the Brain type of thing. Do you know what I mean? It's like Pinky in the Brain. It's like it's mine type of thing. And this kind of whole kind of scarcity mindset. I'm going to call it scarcity mindset. I don't know if it is the right word, but scarcity mindset of, oh, I've got to give my company away and it's my company type of thing. Do you know what I mean? But I don't know. I mean, do you find that those are some of the common, any other sort of common mistakes that off the top of your head, apart from the one that I've thought of?
I mean, that's probably the most common one. And my response to people on that is, if that's really, really, really important to you, that's okay. Keep 100% control, but accept the consequence that you're going to be limited in your ability to grow by whatever money you can put in and whatever money you can generate through revenue. And you might be able to get some loans and things as you grow, but loans you have to pay back and all that. But if you're a little more open-minded, and I always urge people to try and think a little more open-minded. And again, I go into this in some detail in the book. But if you let's just take an example, and this is an example in the book, so your listeners can read about it in more detail. But let's say you own a business that's worth let's say you own a business that's worth 3 million, and you find an investor who's going to invest 2 million into the company. So now the business is worth 5 million. Because it was already worth 3 million, and you've got 2 million in cash. And that person now holds a 40% stake in the company, and your stake in the company is 60%. 60% of 5 million is 3 million. So you haven't lost anything. You're still the largest shareholder, but you now have another shareholder. You'll have another director. You'll have another person involved in the company. They're going to ask questions. They're going to have opinions on the strategic direction. And so it's important that you, as you're going through the fundraising process, that you make sure that you're aligned on these things. But let's say you've done that. Now let's say you're a tech business, and you're now at the stage where you need to hire in a really good chief technology officer, CTO. And in order to attract them in, you offer them stock options. And stock options are it's a thing where it's the right but not the obligation to acquire shares in the company at a future date at a fixed price set today based on the achievement of certain criteria. So that's a big mouthful. So let me just set it out. Let's say today the share price is £1. Or $1. Let's say $1. We'll do dollars, and then it just, for your international audience, because everybody knows the exchange rate between whatever their currency is and the dollar. So let's say your share price is $1. So you hire in the CTO, and you say you have the right but not the obligation to buy shares for $1 at a date 3 years in the future, say. But you have to have delivered this piece of technology, and we have to have grown the size of the company to $10 million in revenue, and you have to still be employed by the company. If you meet those three conditions, in 3 years' time, the company's going to be worth a lot more than $1 a share, but you have the right to buy shares for $1. Okay, so let's say you offer options worth 5%. So both you and your investor have now been diluted by 5%. So you had 60. So you lose 5% of that, which is 3. So you're down to 57. Your investor had 40. They're down to 38.
Yep.
And your CTO has 5. But now let's fast forward 5 years and the company is worth 50 million. You've got 57% of it. 57% of 50 million is 28.5 million. So you started out with 3 million and having 100% control, and all of a sudden you've got 28 million. I mean, that's nearly 10x. And your investor came in and invested 2 million, and they're getting a huge return. They're getting 38%, 7.5 million. Yeah, and your CTO is coming in, and he's getting 2.5. So everybody's won, and the whole idea is you can own 100% of this little pie, or you can own a smaller stake of a pie. And sorry, I got to keep my hands in the screen. A pie is big. You know, what's worth more, owning 100% of a pie that's worth 3 million, or owning 57% of a pie that's worth 50 million? You do the maths.
You know, I think one of the reasons why it's not just the emotional attachments with regards to our conversation, but it's also risk, you know, and I suppose it's all down to, you know, I don't know about you. If I was to bring an investor in my business, there's got to be this kind of connection and relationship. I've got to really believe that I trust this person more than anything else. So what do you think? What's your take on that?
Yeah, bringing in an investor is the business context of getting married. Don't meet someone and rush off to Las Vegas and tie the hitch. Take your time, get to know them. You know, if you're getting into discussions with someone about investing in your company, get to know who they are. Ask them difficult questions. You know, ask them questions. What about, you know, any business that's going to go through a period of growth is going to hit some bumps in the road. How are they going to respond to that? So, you know, ask them, tell them, hey, look, we've got these plans. And, you know, our year 5 plan is to get to a sales revenue of 40 million. You know, what if we only hit 32? How are you going to respond? You know, are you going to be mad? Are you going to tell me I've got to fire people to reduce costs? Or are you going to say, hey, we hit a bump in the road, but we're still on the growth trajectory. Let's keep going. And you need to tease out those kind of things. Especially if you go down the institutional route with venture capital and things like that, because those guys, and again, look, it's their model, it works. I'm not criticizing it, but as soon as something goes wrong, those guys are all over you like a rash.
Good to know. This is really good information, by the way, because I mean, we haven't talked about it, and none of our listeners know, but I'm working on something in secret, but it's all good. You'll know about this, guys. Don't worry about it. It's all good. It's no problem. Anyway, let's talk a little bit about how is it. So if we're a business owner or entrepreneur, whatever the situation, circumstances, and we're looking, okay, so I've made the decision. I want to raise funding for my business, right? I'm going to, you know, jump into the deep end and just do it, right? I've procrastinated for too many years. So my question really is, what advice would you give to those individuals about how I could increase my chances of raising funding in the first place? Because I'm sure that's the $1 million question.
I would say the first thing you should do is, in your community of friends, your network, your business contacts, is there anyone else who's already done that? And take them out for lunch or dinner and say, hey, I'm thinking of doing what you've done, and I'd just love to pick your brains and learn about your experience and you know, what's it been like, what's been good, what's been bad, what's been ugly. So if you can get that kind of input from a few people who've been there and done it, you will go into that next round with your eyes wide open, and you'll really have that knowledge. If you don't have anyone in that community, buy my book and read about it. You know, reach out to me, have a conversation. I can put you in touch with other people who might have been through that. Just go into it really with your eyes wide open, because for a lot of people, it's an area that they don't know much about. And it's an area that if you get it wrong, it can be really, really nasty. I've seen companies go in and rush the relationship side of things because they wanted the money, and all of a sudden, a couple of years down the line, and things have changed, and the market's moved on, and all of a sudden, these were our projections, and they're not happening because the market's changed, and this is what we're doing, and every board meeting becomes a battle, and it's just it's emotionally draining, and it's a pain, because the whole idea is you want someone who buys into the business and you as the founder and your team and where you want to take it, and you want to call on them for their support. You don't want to get into a situation where the first bump that you hit in the road, well, hang on a minute, that's no good, and you've got to do this and you've got to do that. You've got to be able to take the time. So like I said, it's the business equivalent of getting married. So I mean, go on a couple of dates, flirt, see what is, do you like each other? Would you introduce this person to your parents? I'm not saying you have to, but and just take it slowly. Have a series of meetings, have conversations, meet them over dinner. Go away overnight with them, and go on a weekend. Get to know these people, because if they're going to be putting serious amounts of cash into your company and having a say in its strategic direction, and probably having a seat on the board, and there will be a shareholders agreement that sets out where you're allowed to do certain things on your own, but there are going to be things that you have to get their agreement on. So take the time and build that relationship.
Good. Some great points there. Some really good points. And I think that you're absolutely right. I think too many people try to rush through the process because they get too, I suppose they get too emotionally attached to what could potentially be. They get too excited by what could potentially be. But really, it's like you said, if you don't let time mature and you don't do your due diligence, which is super important, which we haven't talked about yet, but if you don't do your due diligence and stuff like that, you're gonna come unstuck, which is a good point. Is there anything else when it comes to relationships? I was going to ask you, actually, we were having a conversation, when was it? It was on Clubhouse actually the other day, and we were talking a little bit about the different, not the different forms of funding, but one of the questions is when is it right to have a pitch deck? Because I know there's a lot of people out there that are thinking, oh yeah, I need to have funding, I need to have like a 50-page business plan, I need to have a pitch deck, I don't know what to do, overwhelm, I'm going to go back to doing what I normally do. Any advice for people like that?
Yeah, I mean, take it gradually. Again, reach out to people in your community. If you've got a friend or a colleague who's done this before, get their perspective on it. You can start the conversation without a pitch deck, but again, through this other program that Adam and I both know well, one of the mantras from that group is you get what you pitch for, and you're always pitching. True. And so stop and think, what is it that you're pitching for? So let's take an example. You're a founder and you're starting to think about fundraising, and you go to a networking event with business angels. You don't need to have a 50-page business plan ready for that. You don't need to have a 20-slide deck ready for that. You're at a networking event. You need to have a 30 or 40-second pitch that tells succinctly, this is me, this is my business, this is what we're looking for. Can we arrange a meeting and I'll take you through more detail? And literally that's it. That's your pitch for that networking event.
Yep.
Then when you go to the next meeting, you might want to have a slide deck ready that you can take that person through, because you're going to be meeting them on Zoom or Teams or whatever. Or increasingly, again, we're getting back to some face-to-face stuff. So you're going to want to have something that's going to guide them through a conversation. But what you're looking at there is saying, hey, we met at a networking function and I gave you my 30-second spiel and you said you were interested. I now have 30 minutes to see if I can get you interested for you to go away and think, hey, I might be interested in investing in this business. And so you might have a pitch deck, but don't overdo it. This is the first of a call. So, go in and have a 10, 15 slide deck that you can give the person or leave behind. That sets out in a little more detail what it's going to look like, and then let them take that and digest it, and then they might say, okay, let's now have a half-day meeting, and then it goes through like that, and at each step you're giving them more information. But you've got to take it step by step. You don't go into the networking session and say, hi, I'm David, I'm looking for 50 million pounds, do you want to invest in my company?
It's a bit like, hey, do you want to get married now?
Exactly. Exactly.
Yeah, you're absolutely spot. It's interesting because I just see so many people making the same mistakes, right? Because it becomes about them and their ego, and like I say this over and time again, trust is the #1 currency, especially in the digital world, especially as like less face-to-face meetings are out there. But trust, it doesn't matter if we're in a digital or non-digital arena, you got to build that. You need that time, don't you, David, to build that trust over a period of time to really get to know that person. And if you can really, really get a gut instinct to see if they're actually wasting your time or not, or they really do have a genuine interest in what you've got to offer. What do you think?
100%. And again, that whole time wasting thing, or time in whatever you want to look. Again, one of the big issues with the venture capital model and with the explosion of companies that are starting up is that the venture capital firms get inundated with people saying, hey, look at my amazing business, I'm going to send in a pitch deck. And depending on which firm you're looking at, they might get 100 a day.
Yeah, probably.
I was talking to someone recently, and this is someone who works on IPOs. So coming back to, was it Daniel's question?
Yes.
So this is someone who works advising companies on IPOs. And he says he currently has a backlog of 70 companies that all potentially could fit the model, but they're all just all of a sudden piling in. And so what happens in these firms, and you could say it's right or it's wrong, it's fair or it's unfair. I'm not going to make a value judgment. This is simply what it is. In those firms, if you have a relationship with someone or can get introduced to someone, and then you can have a direct contact with that person in the firm, if they're a decision maker or a senior player, then you've got a good chance. If you're an unknown person and you log on to their website and it says, are you an entrepreneur? Fill in this type form, upload your deck here. And the reality is that type form and pitch deck is going to go to the most junior, newest recruit into the firm. And they're going to have a checklist, and they've got 70 a day of these things to go through. So on the first pass, you're lucky if you're going to get 30 seconds of their attention.
Yeah.
And out of the 70 that go through, maybe 7 will merit another look, and then they get 5 minutes.
Yep.
And then they'll say, okay, out of today's 70, here's the one that's worth me putting forward in front of my boss.
Interesting. So they'll have their trash can right by their office, and then they'll be playing basketball, right?
Absolutely. And so, if you're serious about going down the venture capital route, do your homework, find out who the people are, use your LinkedIn, use your social networks. I mean, I once saw a famous, I can't remember which one, but it was one of the famous big US venture capitalists, whether it was Peter Thiel or Mark Andreessen, I don't know. Anyway, it was one of the big gurus in the world. And he said, if you can't network your way into a venture capital firm, then why should I be even interested in you? That tells me you don't have the hustle that I want. So
exactly.
Take your time, research the firms. Don't spray and pray. Don't say, hey, I've got this amazing new idea and I'm going to send it to 500 VC firms, because nothing's going to happen. VC firms tend to be very specialized. This one will invest in biotech. This one will invest in fintech. This one will invest in healthcare, whatever. Find out what they specialize in. Look at the portfolio companies that they've listed on their website. Reach out to the owners of those portfolio companies. Ask them about them. You know, maybe you can, if you can get an introduction from someone who works at a company that VC is already invested in, that's like gold dust.
Absolutely. Absolutely. There's one question that really cropped into my head as you were talking. And the one question that I think that a lot of listeners are going to be really intrigued about is talking about valuation.
Yep.
So if I mean, we either build a business to either exit, ideally, that's probably the ideal strategy, is to exit somewhere down the line, however long that takes us. But that's generally what the consensus is. Or we want to hold it and sit on the, on the board of directors and let someone else run the business or whatever it is. Depends on what the strategy is, of course. But I guess my question is, how do we increase the valuation of our companies? What is it that investors are looking for to not only yet for you when it comes to the exit strategy? You know, what are the things that we need to put in place and say, okay, well, I need, here's my checklist. These are the things I need to make sure that I've got in place. So when I'm ready to exit in, say, 5 or 10 years time, I'm ready to rock and roll. Any thoughts?
Yeah. Okay. First up, every entrepreneur thinks their business is worth a lot more than the market thinks it's worth. So just reality bites. So I meet people who come to me and say, yeah, my business is worth 25 million. Oh yeah. Tell me a little bit more about it. Well, we've got $1 million in revenue and we made a profit of 26,000 last year. But Tesla's on a multiple of 1,000 times earnings, so I should be too. Okay. There we are. So yeah, just be prepared to have people come back and say, no, your business is not worth that. Typically, the ways to maximize the valuation of your business, you want to show growing revenues year on year over a period of time. You want to show strong and growing profitability. You want to show cash generation. Those are the kinds of things that investors look for, because in reality, what is a business worth today? It's worth the stream of cash that I'm going to get for it in the future. If I'm going to buy 100% of a business, how much money am I going to be making over that time in the future? And I'm a big fan of Warren Buffett. And one of my favorite Buffettism is I would far rather buy a wonderful company at a fair price than a fair company at a wonderful price. I would rather buy a wonderful company at a fair price. I'm happy to pay the fair price in the market for an amazing business.
Sure.
I don't really care about a business that might be okay, but it might not be. But wow, it's cheap. It's cheap for a reason.
Yeah, exactly.
And again, different philosophies. I know people in the M&A space who talk about going out and buying companies for no money down and all that. That's because those companies aren't worth anything. And you're going to go in. If you're a specialist in turnaround or something like that, then you can do really, really well. But if you're not, if you've never done turnaround before, it's hard work. You've got to make really tough decisions. And I would rather go out and say, hey, I've got this amazing business. I need to raise some money to buy it, but I can show my investor that buying this business is going to be really smart because here's their track record and here's their trajectory. And let's focus on doing that. And I believe that there is a lot more value to be gained through going down that route than going out and thinking, oh, well, here's a business that's failing, so I can buy it for $1 and I'll fix it. It'll be fine. It's failing for a reason.
It's a bit like kind of when some of the department stores, they sold pretty much because they had so much debt. They sold the company for £1 because that was the very minimum amount of money that it was. But you would have to clear the debt of like, I don't know, 20, 30, 50 million quid. I'm like,
exactly.
Okay.
Exactly.
There's the incentive.
Exactly. Yeah, Warren Buffett refers to it as cigar butt investing. Imagine you're walking down the street. And this would only appeal if you like cigars. But imagine you're walking down the street and you see a cigar butt on the ground and it's still kind of smoldering a little bit, but it's kind of gnarly and then there's only a little stub left. You can pick it up and have a puff or two, but wouldn't you rather have a new cigar?
Yeah, exactly.
And if you're not a cigar smoker, the whole thing's disgusting anyway.
I was there. That wasn't a good example for me because I'm an anti-smoker anyway. But anyway, that's all good. It's no problem at all. Anyway, final question because I'm conscious of time anyway. I know that you're doing some stuff in the what was I going to say in helping kind of female entrepreneurs and helping them to become more recognized in the raising capital space and whatever it is. Tell us a little bit more about what you're doing in that space and maybe how can our listeners support your cause?
Wonderful. Okay, so how can your listeners support our cause? So that business is called Funding Focus. We are running our 3rd annual event on the 23rd of November this year. I think, Adam, I've sent you a link to that event. If I haven't, I will. And we can put that in the chat or the show notes, or people can reach out to me. It's an online event running on the 23rd of November from 2 until 6 p.m. And the format of these events is we have a number of female and underrepresented male founders come in and tell their story. These are people who have successfully raised money, and they're coming in and telling their story. And the whole idea behind these events is to provide some inspiration and a sense of hope. And hey, if that guy's done it, or if that lady's done it, there's a chance that I can do it, and I can learn from them, and I can see where they've done it. And we've now got a global audience for that. At last count, we've had people attending our events from 27 countries on 6 continents. So
wow.
If you have any listeners in Antarctica, please sign up. That's the one continent we're not in. But no, yeah. So come to our event. We also do an introductory training program, which is a 6-week online. It's 2 hours a week for 6 weeks. Just gives you a good introduction and overview of the fundraising process. And then if you want help beyond that, then we can have a separate conversation about working with you on assisting you in the fundraising process. So yeah, if anybody's interested, reach out to me. Our website is funding-focus.com. It's currently being redesigned. I'm hopeful that the new site will be up in the next couple of weeks because the old site is actually about last year's conference.
No worries. Well, listen, we'll put those details in the chat box below, and make sure that people have the opportunity to contact you and without you, of course, and stuff. So yeah, this has been a great conversation. It's just flown by. It's absolutely flown by. So listen, guys, hope that you've enjoyed myself and my guest today, David Horne. If you do have any questions, feel free to reach out to David on his social media channels, and you can do so by clicking on any of the links below. And just mentioned the Game Changers audio experience and he'll put 2 and 2 together and whatever it is, and he'll respond in due kind. And make sure that also check out David's book, obviously, Add the Multiply, Amazon. It's on Amazon, all good book record stores and things like that. So make sure you check that out, whatever it is. Just want to say thanks very much to David. Appreciate your time today, buddy.
Really enjoyed it.
Cool. Very cool. So guys, listen, hope you enjoyed today's show. If you have enjoyed today's show, do me a favor, give us a 1, a 5, or a 3, whatever star review that you feel would be worthy of this particular show, and also some of the other previous shows that we've had here as well. Thank you very, very much for today, and we'll see you again on the next Game Changers audio experience. Take care, and we'll see you soon.
Bye-bye.